Financial Management welcomes you all to the event of Market Outlook Financial Year 24. I thank everyone to share their valuable time with us. Like every year, IFM is carrying forward its legacy of delivering services, imparting knowledge, and leaving its footprints in terms of trust, ethic, and knowledge. With the rich experiences of the experts and vintage of 20 years, we are managing close to 1,000 crores of asset under management. This evening, IFM is proud to apprise you all that we are associated with SBI Mutual Fund not only in terms of business, but in terms of providing trained manpower also. India's largest asset management company with over 7.25 lakh crore mutual fund AUM and another 11 lakh crore under PMS as on 31st March 2023. SBI Mutual Fund holds 18% market share in the Indian mutual fund industry. It's a joint venture between State Bank of India and Amundi. Amundi is largest asset manager in Europe and is among top 10 in the world. SBI Mutual Fund believes that risk management comes first before money management, with their vision to be the most trusted and respected asset manager. They have come a long way from AUM of just 1 lakh crore as on March 2016 to more than 7 lakh crore as on March 2023. That is 7 times growth in 7 years. SBI Mutual Fund is having 3 business segments: mutual funds, alternative assets, and offshore funds. Its first mutual fund office was set up in the Gujarat International Finance Tech City, also known as the Gift City. The fund house was assigned responsibility by Honorable Supreme Court of India to manage debt crisis of Franklin Templeton Mutual Fund in 2020. Recently, the fund house has been designated as fund manager by SEBI for Corporate Debt Market Development Fund worth 3,300 crores. To take the evening further, I would like Mr. Iqbal sir to address you all. Sir.
All the state bank chairmen, I think majority of the chairmen and MDs are produced by SBI Mutual Fund now. The current chairman is from SBI Mutual Fund. The MD was from SBI. Ashwini Bhatia ji, who was here, was MD from Mutual Fund. Then he moved to as an MD of SBI. And then now he's the member of, whole-time member of SEBI. So it's a great movement, proud moment. I think he's back to his roots. I am again welcoming from bottom of my heart and would like to request him that he should share.
Introduction of SBI Mutual Fund and SBI, myself, and I was a story when she was saying that I started my journey as a zonal head. I was wondering why, because this is my Karam Bhumi. I started my career in mutual fund from Chandigarh. So that's the most proud thing for me. But now being in SBI Mutual Fund and the numbers which Jyoti has shared, it really gives a lot of proud that we are able to do almost, if I talk in international terms, we are managing more than $225 billion of this thing. And our joint venture partner, Amundi, when they signed the joint venture with us, we were 1% of their overall book. Today, when they talk to the international level that we are managing $2 trillion, and that kitty, Indian SBI Mutual Fund is contributing almost 12%. So that from 1% it has gone to 10%, and this is taking India to the international level and being the largest, being the fastest growing, being the prodigy of State Bank of India, the largest bank, actually gives us a lot of proud that. And see, coming back to IFM, the Iqbal Singh, actually we are like a family, but he's more than a business partner, he's a knowledge partner. Because mutual fund industry is the knowledge industry. It's not the fund management industry per se. It's not a banking industry. It's market related, and in market, look at the products, advising the investors to get into a right kind of product is the most difficult thing. Today, when there are 40 manufacturers as far as mutual funds are concerned, 42 to be precise, and looking into the schemes, doing the research, aligning with the other quantitative the data which is available is not an easy task. And the way this innovative financial consultants are doing, the way Iqbalji's team is doing, is really, really remarkable. Actually, we consider they are one of the few, very, very few, which is in double digit only pan-India, the people who really are working with the customer centricity, the investor centricity, how and which product is to be pushed. And our relationship is not linked to the business at all. It's linked to the knowledge which we share. Whenever he is in Bombay, he spends almost one day sitting with all the fund managers who are managing the funds to understand what is their philosophy, how they are looking at the funds, how they enter into a particular stock, and how they exit from the stock. What are the parameters they look into? So that kind of hard work nobody does. Now coming back to the market, the way India is there at this point of time, when we look at the investment destination, whenever I talk about Punjab, I think as far as investment opportunities from the business point of view, it hurts, and it hurts a lot, because I'm dealing with all the geographies. When we go to Gujarat, when we go to Maharashtra, so much so when you go to Karnataka, when you go to the other day, last week we were in Bangalore, we had the annual convention, and Mr. Mohandas Pai was with us. He was discussing, and when he was saying that Karnataka itself, when India is talking about 5 billion economy, then 5 trillion economy, at that point of time, Karnataka is talking about 1 trillion economy. And when he was showing the data of all the states as far as growth is concerned, as far as size of the economy is concerned, actually when I looked at the data, I was feeling so sad that where the Punjab is and where the Punjab has gone. These states, like we say, all the Punjabis, all the Indians, they are working in US, and US is striving very, very hard on the basis of what Indians are doing there. It could be from our part of the country or from the southern part of the country. Same is happening in India and Karnataka. Karnataka is a different country in itself. All our people who don't want to go out, they are doing their services are growing very, very high in Karnataka and what to do in Punjab. But at the same time, I think these are some things which are not in our hand, but we feel so sad because of the political culture which is there and whatever has happened. Anyhow, I don't want to digress myself from the topic. Now, getting the benefit of these investment opportunities which are available in India, I think at this point of time, stock markets is the best solution, and people are doing a proper asset allocation. We in SBI Mutual Fund always think that beyond banking, it's like a quasi-banking kind of thing. Like when we talk to each other, we talk and the terms of who is your banker, which bank you are dealing with. I think the time has come that the mutual fund industry has grown so much that now we have to talk in terms of which is your mutual fund. Because mutual funds are giving the plethora of products. And we are so, I will say, blessed that we are growing so fast. It's not that we are doing something different, but only thing which we are doing is the customer centricity. Two basic principles: what is good for customers, what is good for investor we will do. Second comes our partner, we have to take care of him, and then last is ours. Because we are the manufacturers and we have to take care of everything that in capital markets so many accidents happen. And our job is to take care of this thing, that we don't get into any particular stock or particular debt paper which gives the negative return, because mutual funds are passed through. Whether we make profit, whether we make loss, it's passed through. We just charge our fee. And we have created a very, very strong research team, very strong fund management team. Just to give you a number, we have a 67 members team, and more than 50% of our fund managers and analysts They are CFA charter holders of USA, which is very, very big feat. And the average age with SBI mutual fund is more than 13 years. They have been there long time. Generally, people say SBI's name, they generally feel that this is a public sector. They may not be able to hold the talent, but that has been our biggest strength. Whosoever comes in SBI mutual fund never leaves. For example, I am there since 1998. It's 25 years now. So that's the culture of the organization, and we have been growing because people trust us. Just to give you another number, you must have seen in the papers of this thing last year. Numbers came as on 31st March. The whole industry has grown up by 1,46,000 crores. Net sales. I mean, total what has been put in the mutual fund and what has been redeemed. Net number is 1,46,000. And we being with 18% market share, we got 54% of the net sales of the country. So that's the kind of trust which people are putting in. And not only that, the SIPs, which is people talking about, we are getting 2,000 crores per month. 2,000 crore rupees coming to the mutual fund schemes of SBI mutual fund per month by almost 90 lakh customers. So that's the kind of number people are coming in, more and more people are joining in. There are 2-3 things. One is the fundamentals of the companies, where we are putting money, and second is the demand supply. So we are at a position to make good for the investors in a big way. That is of the equity. As far as debt is concerned, I remember the day in the budget speech, it came that some tax arbitrage which was available with the high net worth investors, that the indexation benefit was there and that is being withdrawn. The first call which I got was from Mr. Iqbal Singh, that what is the way, what can we do? That's the time of speed, the speed. And he was able to do almost, organize almost 30 to 40 crore rupees from his customers to put in that scheme within those 4 days. And that's what is required for a intermediary, for a real what you call, whosoever is advising you. That's the role of the advisor. So he is fitting the bill completely. There are 10 people in the country whom we have seen all across India, who are even able to get the people who are putting in direct plan. You know, there is a direct plan also. But people are moving from direct plan to regular plan through these distributors because these intermediaries are able to showcase the wealth they are creating. As far as we manufacturers are concerned, we don't mind either it is direct or regular because the management fee which we charge is the same as per SEBI regulation. But I really, when he is there, another 2 or 3 friends of mine are there who have been able to make a difference. So that is something which is really very important for the investors to see whether my advisor is able to handhold and take me away from the accidents in the market or not. Just to give you another example, there was 3-4 accidents which happened in the near past. That was IL and FS were there, which was there, Yes Bank was there, and then it was Diwan Housing. These 3 debt papers defaulted. And we being the largest, automatically there would be, how can the largest be avoiding it? And I tell you, we didn't have even a single penny in these stocks, and there are documents which are put in by the research team 1 year ago that these people are not doing well, we should avoid these papers. So the point which I am trying to make is, do trust the manufacturer who is doing it, do trust the intermediary, the advisor. That's so important that we do it. And I think we, as the well-wishers of the society, I know in the way Mr. Iqbal Singh believes in giving back to the society beyond a point. I think from the investment point of view, we need to educate people. Please get into this, because in our part of the country, in any case, we don't have any growth as far as businesses is concerned. But if you want to participate in the growth of the country, the only way to participate is to participate in the market. Because we can't start our businesses, ecosystems are not there, and we can't do too much. Yes, we can invest. Mutual funds is into the listed space only. There are people who are getting into the unlisted space. There are AAFs, there are PMSs. But starting the journey, the simple thing is coming through the mutual funds. And that's what we are doing. We do have PMSs, very good. Mr. Iqbal Singh is also, having one of his own PMSs, which is one of the best in the country. So those things are also there, but what we are doing with PMS is now in listed space. We are bracketed with this thing, but category 2, category 1, which AIFs which are there, the time has come when we will get into this, because the businesses are growing very, very fast. The kind of profitability is coming in is among us. Especially when we look at it, the overall, more than 30%, 40% business is happening in 2 states, that is Maharashtra and Gujarat. See, peeking at those companies, because our people don't understand the business investment, so it's better to educate more and more people to be part of it in a staggered manner. When we talk of SIP, we generally think that SIP means the small investors. That is not correct, because SIP means you invest in the market in a staggered manner, not in a lump sum manner, because that fights the volatility. So that's something which is happening, and happening in a big way. It has become a global success story. The Indian SIP story, which is 14,000 crore rupees per month, is likely to be 20,000 crore by the end of this financial year. 20,000 crore means almost $3 billion every month will come from the small investors and the HNIs in a staggered manner. So that's how the market will stay very stable. And over and above that, this Employees Provident Fund organization, they have invested more than 2 lakh crore in equity, and fortunately we are the fund manager for EPF also, though they are putting only in the ETF as of now. But going forward they will also get into the active funds, means the normal funds, and they are increasing their percentage from 15 to 20%. So again, the more and more money comes with the more listed companies coming, I think this story is not going to end. There could be small time volatilities. So be in the market, continue with the market. I think that's the way to go. And the kind of growth which is happening, that the numbers clearly show that how the people are putting more and more money. And Jyoti was talking, she said we grew 7 times in 7 years. SBI Mutual Fund came into being in 1987. It took 28 years to reach 1 lakh crores. The moment we professionalize the whole organization, the last 1 lakh crore, 6 lakh to 7 lakh crore, happened in 239 days. So that's the kind of growth which is happening, that's the kind of speed which is happening. Now because of volatility, we have taken some time from going to 7 lakh to 8 lakhs. So yesterday also, as I speak to you today, within this year we have grown by 30,000 crores in last 12 days. 30,000 crores. That's the kind of growth which is happening. People are putting more and more money. Because in banking there are 2 things. One, the taxation. You have to pay tax every quarter, irrespective of whether you encash it or not. I'm talking about the debt side now. So there are parallel products. But I will call upon you, whatever money you put in the equities, whatever allocation is happening in equities, do that. But the remaining, whatever is there in the banking instruments, at least for next 1 year, that can be put in the debt funds. Why I am saying so? Because there is a clear indication that interest rates will go down from here on. If I have got 1 crore of rupees lying in a FD, so that will give me today 7%, whatever. The same is the yield of the debt paper, 7%. But there is a likelihood that the interest rates will go down from here on. If the interest rates go down by 1% from this level, and I have put in 1 crore rupees, so if my duration of my paper is 10 years, if I take a 10-year paper, the market will value it at the 6%. So my 1 year return will be 7% plus 8% more for the remaining 8 years, which has come down, will be 15%. This is simple, I think. It's not that easy to understand, but Iqbal will let you know. That's what we are saying. The tax arbitrage is gone, no problem. But still we can play duration, and at least for 1 year. Thereafter, when you can come back to bank deposits or something, when we say that the interest rates are going up, when there's a likelihood of interest rates are going up, it's always better to keep money in the banks as a deposit, not in the mutual funds. When there's a likelihood of interest rates going down, and there's a unanimity because there are two views. Some people can say it will come down, some people say like equity market, some people say market will go up, some people will say no, market will go down, that makes the market. But as far as debt is concerned, fixed income is concerned, generally there is a unanimity, and there is a unanimity at this point of time that interest rates are likely to come down by 100 to 150 basis points. That is 1.5% in next 1 to 2 years. In that scenario, it's always good. And just for the, I told you that Iqbalji put in 30 crore rupees of his investors in this. In last 15 days, those have got an annualized return of already got, that means 12% interest has already come for that annualized return. So that's something which is the power of thing, because interest rate has come down by just 1%, 10 basis point, 740 to 730, the yields have come down, but the actual return is 1% in 10 days, 1% absolute return. So that is the time, I think this is time to take a call whether we want to keep in bank deposits. So somebody will say that in SBI we are competing with our own product. That's right, but from the investor point of view, from the customer point of view, it's very necessary, because asset allocation is the key. It's not that if I have got 100 rupees, I'll put whole the 100 rupees in equities. Nobody will do that. Generally, nobody will do that. So there are exceptions to the rule, but generally there's some people who are aggressive. They will put 70% in equity, 30% in debt. When mediocre will give 50-50, and the conservative will do 30-70 kind of allocation. But whatever allocation is there in debt, I think there's a time to look at the debt part of the business, when debt part of allocation, and we have multi-asset fund. There are ways and means to grant tax in the mutual fund, which is not there in bank deposits at all. And then if we talk about the other asset classes like real estates, see, and I know one of the wealth managers has got one department, complete one department, who is helping his clients to encash, to monetize the real estate, because real estates are not given any return for the last few years. I don't know what is the position in your part of the country, but at least other places it's very bad. So they are encashing it, they are putting into financial assets, but I think this is a time. And see, again coming to Iqbalji, I think in this part of this, there's no parallel. So it's not that I am praising him because he's a friend, we have been dealing with this thing, but it's actual, see, more than relationship, more than narratives, is the numbers which talk. When I look at his whole portfolio, we do the analysis of our partners on the basis of how much value they have created for their investors, and we get it mandated by independent parties also. So the top 50 people who have really created value for the investors, Mr. Iqbalji is one of them. I think he needs a kind of applause for the wonderful work he's doing. So I'm there, but I from SBI Mutual Fund point, I would say we are knowledge partners with Iqbalji, and see, we do everything which is good for the investors, and whenever he comes, he gives us a lot of suggestions, and we implement those also. We have though on the numbers we see 18% market share, like SBI is in banking industry, we are in mutual fund industry, but our team is lean. Pan India, we have got only 1,000 employees put together, because we are business to business, we are not business to customer. Business to customer is there, we have digital tools, anybody who comes is welcome, but I told you the value which an advisor can create. So thank you very much for your time, and I'm around, so we'll definitely discuss. Thank you so much. All the best, advisors.
And the whole day, again, 14th of April, we have chosen because we are working on 4 E's. One is education. Second is employability in this part of the world. Today, with the grace of Almighty, for all the financial institution, and even Mr. DP Singh supported us in that. So we have a mandate of placing 600 unemployed youth, undergrad, postgrad, in this part of the world. And unfortunate part is that majority of the people who are coming for employability is not from Punjab at all. They are coming from Rajasthan, UP, Uttaranchal, Himachal, and because all Punjab guys, they're saying we are star, we have to go to Canada or here only, and job is not. So the point is a mindset issue, and it's really concerned me. And the third part again, which is creating an ecosystem, and I would like to compliment Sahil, who is here, has put up a very good show today. In terms of an ecosystem, we are creating and trying to create an ecosystem. I think the people from Chennai, Bangalore, Mumbai, Pune, I think majority of the domain expert who was here today and gave a lot of insight for our youngsters here, who want to do a startup, mentoring, coaching, guidance. And in fact, the announcement for 100 crore of fund has also been announced today for the startup in this part of the world. And last year is definitely the enterprises. So last year, there is a company called Jina Sikho, where we raised the fund for them. And I'm doing mentoring for almost 10 enterprises today who are going to be get it listed on the NSE Merge platform. So we want more and more companies who should come and they should get national exposure. So I would like to focus my presentation on market outlook. As DP Singh has shared that on a very short notice call in the last week of the last financial year, when there was an amendment by the finance minister that there is indexation benefit you are not going to get from 1st of April. So in 4 days, we actually, all the team, they work together and almost garner more than 20 crores. And all that investment has already yielded 1% absolute return. And I think more fruit has yet to come. So when we talk about market outlook, I just want to share with you, I think I put up numbers in a very, very crisp manner so that I can involve everyone in this, all these numbers and what is our viewpoint on the marketplace. First of all, I would like to share with you that how the global market movement, because a lot of people are saying that India has not done well as such. So, in the landscape of the global markets, how we have fared in the last 1 year. So if you see, the DAX is a German market. Again, it is the best market in the world, although we are saying that in Europe, things are not that great, followed by FTSE, which is UK, then Nikkei, then BSE, Sensex and Nifty. Last year, they have delivered a return of, Nifty was minus 0.60%, and Sensex was up by 0.72% because Nifty you have a more weightage of IT, and IT was the one of the sector which has the worst performing last year. Then S&P New Zealand minus 1.86%. Then Dow Jones, which is the major market, which is down by 4.5%. FTSE China 50, which is 9.02% minus. S&P 500 down by 9.29%. So let us suppose when we talk about US, although people will talk about S&P and Dow Jones, but the broader indices is S&P 500, which is representative of the 500 companies of US, which is down by 9.02%. KOSPI, which is Korea, down by 10.18. NASDAQ down by 11.17. CAC, which is France, which is up by, I think it's up by 9.95. S&P Australia, which is minus 4.29, and Straight Time, which is Singapore, which is down by 4.39. So this was the last year behavior. And if you look at the various sector, the sector which we have already written off, they have done wonders. The first sector which has done well is Indian defense, Nifty India defense sector, which has delivered 48.59% kind of a return, followed by Nifty PSU. A lot of people have written off the PSUs, and even in the PSU, if you look at, it is up by 36.34%. So again, all the sector, FMCG, auto, banking, again banking is an outlier, it has delivered 11.64% return. Then Nifty mid cap, which is again a representative, so it's up by 3.46%. Nifty infrastructure, which is up by 1.44%. And S&P 500 again, Nifty mid cap, which is up by 1.55%. But if you see that the most promising sector from the bottom, which is called Nifty IT, it is down by 20.98%. So I think in my career, I have not seen in the last 15-20 years that IT was down by almost 21%. Then Nifty Media, which is down by 28.56%. And metal was down 14.42%. Energy was down 13.81%. So this is pharma, which is again down by 11.54%. Consumer durable down by 11.44%. So healthcare down by 10.03%. Oil and gas minus 9%. So the point is, overall basis, yes, very few sector has done well. But the fall in the most promising sector was quite severe. I think the good news in the last 1 year, if you see the behavior of the crude oil, it was $123.58 per barrel on 8 June 2022. You see the fall. So I think it's a good news for India because we are net of import, and we are in March, so we are hovering around 86, and again all the policy rate, they have kept the crude at 85, 86. So based on that, all the projections we are doing, so it's a good news that if it is not going to boil beyond $100, it's good for India. And if you see that US dollar INR currency behavior, again, we were hovering around the same level of the last year. It was 83.01 on 19th of October, then 82 in December, then 82, then 80. So I think it has not moved much. Our currency has definitely shown some resilience, but if you see that behavior of dollar index against the 6 currency where we will look at it, it has moved from 118 to 100 to 103. But against USD as a base currency against INR has not moved anywhere. So it's our currency has shown a reasonable resilience in the last 1 year. As Mr. DP Singh has shared, it's very interesting that earlier we were very much vulnerable to the FI's flow. Now, whole year we have seen a huge outflow by the FIs, but it is again supported by the DIs, domestic institutions, as well as the SIP money which he's talked about. 14,000 crore is the every month inflow to equity from the small investors or HNI investor, which is continuously coming. So if you see that the trend, if you see the trend, the total FI's net flow in FY23 is 1,98,639 crore. You see on the top. And the DI, the net flow is 2,55,236 crore. Again, sir, when we talk about this number, almost 25 billion, in outflow, and 30 billion is an inflow, because it is predominantly supported by the small investors. So the point what I want to share with you is that as we are talking about, this number is likely to grow further up, and we are expecting that this number in the next 6 months will go to 20,000 crore. And there's a small participation by each and every individual into the market, because what I'm looking at the trend from the last 10 years, I am dealing with all the super HNI clients. We have seen a huge inflow of NRIs in India, I think maybe 10 years back. Now, what we are doing officially, legally, we are selling all the financial, physical assets of clients and remitting the money abroad to their next generation, because ultimately 250,000 US dollar under liberalized remittance scheme is going out. You can invest financial assets or maintenance of your kids or otherwise. I have not seen a single penny of inflow of HNIs in India. So it's a majority of the money, people are selling their physical assets and that money is going abroad. Every year, in fact, for the new large transaction, because as per the policy, you cannot remit more than 1 million US dollar per person if you have to sell any asset from India. So the point is that you have to do in a scattered manner or you have to take the RBI approval. But every individual, again sending and remitting money abroad. So what I'm saying is that definitely because of the financial inclusion in India especially, the domestic inflow is quite substantial. This is one of the indicator of volatility. Again, the bad news is that last year we have seen people invest into equity because there is an underlying inherent risk. And when you are taking risk, then definitely you have an expectation also that I'm going to get a better return than the fixed income instruments. But last year is a disappointing year where the volatility was very high, and although gradually it reduces, but the market has not delivered returns. So we have to see that in the whole journey, there are various phases where you don't make money, maybe 1 or 2 years. But that is not going to be one should disappoint on that. We expect that things will become better. So in last 1 year, this is the trend of the market. Again, hover around 18,000 level, plus minus 1,000 points. And again, in the last, I mentioned here that Nifty has not moved anywhere in the last 18 months, even in spite of 25% growth in the earnings. So if you look at the Nifty 50 companies, which is representing in last 18 months, the earnings of all those companies in terms of profitability has gone up by 25%. So the point is that the market has to catch up with this incremental growth in the earnings of the company. And the good news is that if the interest rates going to be remain status quo here, which has been indicated by RBI, we expect that markets will behave positively. I think the biggest key takeaways from the budget is the capital expenditure. And we have never ever seen that almost 10 lakh crore has been kept for capital expenditure. Earlier we started with 3 lakh crore, then 7 lakh crore. Now, there's an incremental jump because these capital expenditure, whether we are talking about road transport and highway, whether we talk about railway, whether we talk about Jal Shakti, the incremental growth number is very huge. You see that 24%, 48% growth in railways budget, which is for capex only. I think that will give a multiplier impact to the GDP of the country. Because the point is that, in the past, none of the government has put up so much into the capex, because the capex always have a multiplier impact over years, maybe next 5 years or 10 years, and connectivity helps in a big way. And I don't want to share, I just want to see that the connectivity from here to Punjab through one of the flyover to Chandigarh University, I think it took almost 1 hour. Maybe 1 year back when this flyover was not there, which is 4-kilometer flyover, and it took almost now 13 minutes. I have a farmhouse next to Chandigarh University. So the point is, it took almost 1 hour 1 year back. So the point is that connectivity definitely helped in terms of improving the productivity. This is a bad news, and again I think the whole world is grappling with inflation. And we are used to high inflation in India. But the world is not used to. I think we have seen the inflation across the world is so high, and people have not seen in 100 years, especially in US, in Europe. You talk about any country, I think we have never ever seen inflation in Japan. You know, in Japan also, if you see that third from the bottom, I'm seeing inflation is, last inflation number was 4.3 and now inflation rate is 3.3. And we have seen almost maybe 20 years a deflationary environment in Japan. We have never seen inflation there. So the point what I want to share with you is that when you talk about to your counterpart or otherwise people, if you see that one is called inflation targeting, all central banks are doing that. So this is prior inflation YOY, this is the last number which has been reported because we took this data from Thomson Reuters, which we are using for our research. Then inflation rate, which is the current inflation rate, and these are all the policy rate. So what we want to share with you here is that you see that majority of the developed countries also are struggling with the inflation. You know, and if you see that Argentina, Turkey, I'm seeing England, Italy, Germany, I'm seeing US dollar. US, you have never ever seen, although the number has dropped from 6.41 in US to 6.04 right now, and it's dropping quite fast in the last 3 months or 4 months. So the point is, even this number is very high. They have never ever seen such a huge number. So that leads to increase in mortgage rate. That increase to, it's very tough for them for survival. People are moving from mortgage and selling their house or moving to the rental income. So the point here, whatever I want to share with you is that this is very, very high. Although, if you see this last third and fourth column, it is dropping quite significantly. And as far as the India is concerned, it is 6.52 last number, and the latest number is 6.44. And this is, so recently the latest number for March was 5.66. So it's dropping. Again, in the last 2 years, we have never ever seen a real return positive. So what does that mean basically? That if your money is lying in a fixed deposit, your inflation is much, much ahead of whatever the targeted inflation which has been kept by the RBI in terms of 4% plus minus 2%. So that means that your upper limit for the inflation, that should not be beyond 6%. And we have never ever seen that inflation in that band. So inflation was 7.5%, then 7%. For the whole year, it was above that particular band. So that leads to negative real return. Because your inflation is 7%, you're getting 6% from deposit or otherwise. So you're ultimately, what you are saying is your money which is there, which is actually, reducing its value because your real return was always negative. But now the good news is, what is that good news? The good news is that real return become positive after quite a long period of time. So the point is, when we are talking about, so this year, the RBI in his policy, its policy, I think there may be minor variation because more and more data will come in. But if you see that the retail inflation projection for FY24 was 5.2%. The good news is that latest information, the latest data suggests it was 5.66 for March. So that means ultimately government is trying that in FY25 we will come back to 4%. So if that is going to be the case and that is going to be the trajectory going forward, and they have upgraded marginally by 10 basis point the real GDP growth projection for FY24. So The real return become positive after a very long period of time, which is 6.5% minus 5.2%. That is positive 1.3%. And that also give a leeway for the RBI or the central government that there is going to be a pause for a longer period of time of the interest rates. If you see that repo rate, again in my historical financial experience, I have not seen that repo rate, which was 4% in April 2022, has moved to 6.5% by March 2023. So there is 2.5% rise in repo rate, and it hurts everyone. It hurts industry, it hurts the businesses because your cost of fund will go up. It hurts mortgage business, it hurts every business. So in the last policy, they have mentioned that MPC decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligned with the target, which is 5.2% in FY24, then move to 4% in FY25, which is the inflation targeting which has given by the central government to the RBI, is achievable while supporting growth. So the interesting thing which I've already shared, that market has not moved anywhere in the last 18 months, even in spite of the Nifty 50 companies. When we estimated, we have seen their earning growth, EPS growth, earning per share growth, which is almost 25%. So what I want to share with you is that if you see that in the first phase, till 2021, till COVID period, if you see that from 2009, the Nifty EPS was 211. Then in 2010, 235, and it has grown to 442 in 2021. So that means, that growth was almost 6% over 12 years. I'm talking about earning growth, EPS growth. But what happened post-COVID? In FY22, the EPS for Nifty 50 companies have moved to 762. And in March, it has moved to 849, the year which we have concluded. So if you see these two bars of last 2 years, there is a huge spike in terms of the EPS earning, even in spite of the commodity prices were high, interest rate was high, but definitely there is a demand. So what I want to share with you is that over these 14 years data, if you see on the left side, Nifty EPS CAGR from 2009 to 2023 has gone up, because last 2 years the earning was very, very promising, is 10.46, and Nifty CAGR from 2009 to 2030. So EPS has grown by 10.46%. And Nifty, which is a market, the Sensex and Nifty moved by 13.03%. So what I'm saying is that in this year, if we have not received any returns, even in spite that earnings have improved, we have to be little patient. I think the results are going to be better in FY24 and FY25. And same thing we have taken for a shorter duration from March 2022 to March 2023, where Nifty EPS has grown by 11.46%, whereas the Nifty, which is the Sensex and Nifty, has given a negative return of 0.60%. So what I want to share and project here is that ultimately markets are slave of earnings and earning growth. Ultimately market has to catch up. If there are earning which is coming in and there is a promising growth in that, I think the good news is the market will definitely sooner or later catch up. So it's only markets are testing our patience. So we have to remain patient. In terms of market valuation, as on 31st March, Sensex, Nifty Mid-Cap 100, which is a representation of top mid-cap companies in India, and Nifty Small Cap 100, which is again a representation of small cap companies in India. So by way of market capitalization, SEBI has put up that 1 to 100 companies, they are large cap companies. From 101 to 250 companies, they are mid cap companies. From 250 onward, this is called small cap companies. So if you see that Sensex and Nifty has not delivered anything last year, even mid cap has not delivered anything, and the largest fall that was in Nifty Small Cap 100, which is down by minus 13.81%. Now world over, we use 3 valuation metrics. These are the metrics which is used worldwide. Trailing 12-month PE, that is the first matrix. Price to book, that is the second matrix. Dividend yield, which is the third matrix. It is used worldwide. If you see that the earnings have improved, but the prices or the level has not gone up for the markets. So with that, what happened? The valuation become attractive. Still what we can share here is that Sensex is trading at 22 times, Nifty is 20 times, Nifty mid cap is trading at 21 times of the earnings, and small cap is trading at 16 times. Again, the valuation has come off because of 2 factors. The earning has improved, but this PE price has not improved. Price has yet to improve. And same thing if you look at the price to book value, it has also come off marginally from 3.23 for Sensex, Nifty 4.05, Nifty mid cap 100 2.47, and Nifty small cap it is 2.52. And the dividend yield, because market has not delivered anything, has again hovering around 1.25 to 2%. So what we want to share here is that in last 3 years, if you see the trend, FY21, FY22, FY23, if you see that in FY21, when there was a COVID and opening up, the Nifty has given a return of 70.87%. And the subsequent year, the Nifty has given a return of 18.88%. And the last year, we were negative by 0.60%. Now, but the good news here is that valuations have discounted now. I'm saying you that you are paying in FY21, you are paying 33 rupees, 33.2 rupees to earn 1 rupees. Today you are paying 20 rupees to earn 1 rupees. So that means the valuation has receded quite significantly, and it is, I think, in an attractive zone. And same thing if you look at price to book value, which was 4.20, then 4.46 in FY22. In FY23 it is 4.05. Again, I'm not saying there is a substantial drop, but definitely there is a drop. And again, because market has not moved anywhere, so dividend yield has gone up. Because this is again one of the valuation metrics. We are saying that earnings are improving and companies are paying you the dividend, but market has also dropped. This is our IFM captive template which we use. I am very lucky today. I have now 5 analysts, and majority of them are either CFA or CFA level 3, CFA level 2, CA. So they are passionate. It's a complete passionate team. We work together, and few of our analysts, again, they have also, we lost to Canada, migrated 2 of my CFA analysts. So the problem is that it's very difficult to hold back the talent. But again, I think we are nurturing, we are grooming a lot of talent. I don't want to go into the details of this, but I think over 25 years of our experience, this is a captive template which we have created on Thomson Reuters on IFM name. And you know, we are getting all the blue-red numbers and how they are behaving. So I don't want to bore you with all those numbers, but definitely few things I would like to share with you that if you see that credit to industry, which has grown from 8.6%, 10.1, 11.1, and now it's 14.3. It's a good news for bank. And credit to service again has grown. Deposit growth has grown. I think I have seen after many years that credit offtake took place, maybe for working capital or term loans or otherwise. And it's a very good news. Now, majority of the financial institutions are struggling to garner the liabilities. And I was told even SBI is repricing to garner deposit because they are having a very strong visibility of credit growth which is taking place. And that we have seen in the last almost 2 quarters, that credit growth has picked up. And if you see that weighted average lending rate of bank has definitely moved from 8.8 to 9.4. Weighted average deposit rate of the bank again moved from 5.3 to 6.6. But there is a lot of fight which is happening between private sector bank and public sector bank to garner more deposit, because there is a clear-cut visibility after a long, maybe 7-8 years, that there is a double-digit credit growth and demand which is coming in. And this is the industry, again, mining, IIP, mining, manufacturing, electricity. I just want to share and touch PMI manufacturing index, PMI service index, PMI composite index. If you see that anything above 50 is always good. So it is also improving month on month in terms of the number. Then consumer, I think passenger vehicle sale from negative in March 2022 to positive 11%, two-wheeler again positive. Tractor sale was negative in the last 2 months. But if you see that biggest rise is in air traffic, which was in March 2022, it was 33.4% growth. Now you see that in January it was 114.7, and in February it is 55.2 YOY in terms of the growth. Then again, foreign tourist arrival, it's okay. Major port traffic again has grown from 0.6% to 11.8%, the data which is there. The bad news is definitely the export growth, which was 22% in March 2022, is showing a negative number. So we have to look at it very seriously, how we can improvise the export. And import growth is again negative. So the most challenging thing, which is the inflation, which is mentioned there, CPI, which is known as headline inflation. And then we have core CPI, which is very sticky, and WPI again, dropping. Again, the numbers, whatever the latest number, because which is coming in, is quite favorable. Again, by improving the compliances, government is not in a trouble now on the fiscal deficit side. And we have already reached to 1,60,000 crore of a GST collection, and the number is going up. And I don't have any doubt that it will touch 2 lakh crore very soon. So the point is that there is a buoyancy of revenue, whether we talk about direct taxes also. We have seen almost 35% growth in direct taxes. And now I think we are also filing a return for a lot of our clients. We always say that, we should follow 26 AS, annual information report, because the compliance has gone up. Earlier, we were putting on any number on saving bank account. Sir, ये डाल दो ये number, कोई बात नहीं, इतना interest होगा. Now the point is that everything, pre-filled, everything is on the sheet of 26 AS, or it is available, so you can't do anything hanky-panky. Everything is coming under the ambit. So the point what I want to share with you is that because of the compliance, the revenue has gone up quite substantially for direct taxes as well as indirect taxes. And that will also give the leeway to the government for do an incremental capital spend, although in this budget they have to borrow almost 17 lakh crore, because budget is around 43 lakh crore and the revenue collection is around 27, 28 lakh crore. They have to borrow 17 lakh crore to replenish the deficit. But the good news is that revenue is improving. This is a point which I want to share with you, the credit growth for all the banks. If you see that 17-18, the credit growth was 6.5%, 10%, 13%. Month on month it was very poor. Now you see the credit growth has picked up. I don't know, that is because of a pent-up demand. It may be a genuine demand. It may be replacement of your two-wheeler, four-wheeler, mortgage, upgradation yourself. I don't know. For businesses, they are running at a good capacity. So whether greenfield project or brownfield projects, things are, strong demand has come in the last 2 quarters. And I don't think that this demand is going to die. Even in spite of, there is a lot of challenges globally for the markets. So Indian GSEC yield, again, 10-year benchmark yield is 7.21. And if you see that the yield curve is flat, if you have to borrow for 40 years, you can borrow at 7.35. So, or if you want to do even investment also for 40 years, this is availability by the central government. The government is raising the money at this rate, at an elevated rate. So, we don't want to take any credit risk. One of the fiasco, and majority of our clients, they are aware of the Franklin fiasco. And in that case, the mandate goes to DP Singh, to bail out all the Franklin investors. So he was the signing authority to return back the money to all the shareholders or to all the unit holder and investors. So the point is, even in spite you don't want to take any credit risk, whether it's Ambani or Adani or any corporate paper, the government is giving you 7.21 or 7.35%. They're raising the money at the highest level today. So the point is, it's a good news is that we can block that. And there is no counterparty risk, there is no credit risk.